Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 278 on July 7th, 2023. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on EOS Energy Enterprises, Uber Technologies, and the United States Steel Corporation, and we discuss three new trades on Hut 8 Mining Corporation, Quantamscape Corporation, and Beyond Meat, Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. And for anyone that wants to learn how to trade options, I teach students how to trade options, not just study theory, with the combination of videos and live coaching calls. If you're ready to take your trading to the next level, send me an email to schedule a phone call. Now, the equity markets closed lower on this shortened holiday trading week. The Dow Jones Industrial Average lost 672 points, closing at 33,734 points. The S&P 500 index lost 51 points, ending the week at 4,398 points. And now it's time for the topic of the week. The topic of the week this week is cheap options. Are cheap options actually cheap? This question came through a good friend of mine who was considering buying a low-cost option, hoping for a high return. In fact, he told me that he felt like the option was mispriced. Having been a market maker for options, I know that the guys that price options are really good at what they do. Options are priced exactly where they're supposed to be given the time before expiration, the current expectation of volatility, the underlying stock price, interest rates, dividends, and any of the other factors that might affect the stock price before and including expiration. Now, you might have a different expectation of where the underlying stock price will go, but that does not mean the option is mispriced. It means that you are expecting the stock to move in a particular direction, and therefore you are buying that option hoping to benefit from that movement. I explained to him that low cost or cheap options are priced where they are for a reason. That low price is an indication that the market does not expect the stock price to reach that strike price before expiration. Now, don't get me wrong. I'm not saying that the market price is always right relative to what happens to the stock price at expiration. What I am saying is that the option's current price is a reflection of all of the information the professionals have at that moment. You could spend your entire paycheck buying 10-cent options. In many ways, these are like little lottery tickets. And much like lottery tickets, most of these will expire worthless and out of the money. But you might have a few winners if you're lucky. Now, I don't count on being lucky. So does this mean that I don't buy cheap options? No, it doesn't. There are times when you can buy a low-cost option and make a nice profit if the stock moves in that direction. When this happens, I still don't hold the option until expiration. I simply look to sell the option for more money than I paid for it before expiration. That's always a great feeling, and still, I did not say that the option was mispriced. It was cheap for a reason. There are strategies for making money with cheap options. They typically do not include holding onto those options until expiration, unless you sold them, of course. Now, some of you may want to challenge me on this, and I'm always happy to have the conversation, so feel free to send me an email. If you use cheap options as part of your trading strategy, specifically if you're buying cheap options as part of your trading strategy, I'd love to hear from you, especially if you've been profitable consistently. So shoot me an email, and I'd love to hear your strategy. So that's it for the topic of the week. Let's go ahead and discuss the review from last week's trades. We're going to start off with the covered call from EOS Energy Enterprises. That's E as in Echo, O as in Oscar, S as in Sierra, E as in Echo. At the time, the stock was trading for $4.34 per share. I looked at buying stock and selling the July $4.50 call at 45 cents, hoping for a return of 14.06% in 3 weeks. Well, shares of EOS Energy gained 20 cents, ending the week at $4.54 per share. The call option we sold gained 20 cents, leaving us with zero change on the week if we were to close the trade out immediately. However, with the stock price above $4.50, we have a much higher likelihood of capturing our full expected return of 14.06%. Now, I'll keep track of stock over the next couple of weeks before expiration, but no adjustments are needed at this point. This trade is working out so far. Next up, we have a credit spread on Uber Technologies, symbol U as in uniform, B as in Bravo, E as in Echo, R as in Romeo. At the time, the stock was trading for $43.16 per share. I looked at selling the July 42.5 42 put spread at 16 cents, which could give us a maximum possible loss of 34 cents per spread. Well, shares of Uber lost 25 cents, closing on Friday at $42.91 per share. The out-of-the-money put spread we sold is still 41 cents out of the money. That means that our spread is still profitable even though the stock ended the week lower. Now, as long as stock expires above $42.50 in 2 weeks, this spread will expire worthless. I'll definitely keep an eye on stock just in case I need to sell a call spread against this put spread to create an iron condor, or even in case I decide to turn the spread into a debit spread if stock truly falls below our break-even point. So at this point, no adjustments are needed, but you need a strategy. We only have 2 weeks left, so you need a strategy to make sure that you can remain profitable in case the stock continues heading lower. And our final trade from last week was a debit spread on the United States Steel Corporation, symbol X as in X-ray. At the time, the stock was trading for $25 per share. I looked at buying the July 24.5 25 call spread for 32 cents, which could give us a maximum gain of 18 cents, or that's a 56.25% return in 3 weeks. Well, shares of U.S. Steel fell 90 cents, ending the week at $24.10 per share. The in-the-money call spread we bought is now out of the money, and that means we're losing money on this trade if stock were to expire below $24.50. Now, with 2 weeks left before expiration, we truly have to decide if we expect this stock to remain lower or if we think it'll push higher in the next 2 weeks. Now, if you've listened to this show for a while, you know that I don't advise on simply hoping things work out. I warned in last week's show that stocks can make counter moves in periods around holidays due to lower volume, and we just finished a 3.5-day trading week. So my first plan is to be patient this upcoming week to see if the stock is going to pull higher. Now, if stock remains lower, I'll look to turn the debit spread into a credit spread by selling the July 24.5 25.5 call spread. This would allow you to limit the losses, though it does open you up to some additional risk of loss on the trade. So remember to always do the math before you make any adjustments. Still, there's only 2 weeks left until expiration, and that risk is going to be limited because we are trading spreads. So when you trade a spread, there's only so much money you could lose anyway. So if you choose to create a credit spread, you can also sell a put spread against it to create an iron condor, and that will allow you to take in even more option premium, which could take you back fully into profit and allow you to limit the maximum risk on the condor, the iron condor. So either way, it's good to have an idea of next steps and how you will trade this if stock remains lower. So right now I'm going to be a little more patient over the next few days, but if stock remains as low as it currently is, I'm going to have to make an adjustment. All right, so that's it for the review of last week's trades. As a reminder, there are only 2 weeks left before the July expiration on July 21st. So this is the last week that we're going to be looking at trades using July monthly options. So we're going to start off with our covered call, looking at Hut 8 Mining Corporation, symbol H as in hotel, U as in uniform, T as in tango. The stock ended the week at $3.80 per share. I'm looking at buying stock and selling the July 4 call at 20 cents, which could give us a maximum return of 10.53% in 2 weeks. Now you enter this trade by buying stock for $3.80 and selling the July 4 call at 20 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price on this trade is $3.60 per share, and in real terms, the stock purchase will require $380 and you'll collect $20 for selling the option. Next up, we have a credit spread on Quantamscape Corporation, symbol Q as in Quebec, S as in Sierra. The stock ended the week at $8.78 per share. I'm looking at selling the July 8 put spread at 17 cents, which could give us a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the July 8 put at 37 cents and concurrently buying the July 8 put for 20 cents. This is a credit spread because we are selling the spread. This trade makes the most money if stock prices expire above $8.50 per share. The break-even price is $8.33 per share, and in real terms, you would receive $17 per spread that you sell and have $33 at risk. And our final trade on the week is a debit spread on Beyond Meat Inc., symbol B as in Bravo, Y as in Yankee, N as in November, D as in Delta. The stock ended the week at $14.78 per share. I'm looking at buying the July 14 half call spread for 32 cents, which could give us a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Now you enter this trade by buying the July 14 call for $1.45 and concurrently selling the July 14 half call at $1.13. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $14.50 per share. The break-even price on this trade is $14.32 per share, and in real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. So that's it for this week's show. Thank you guys so much for following me week to week. Thank you for all of you who sent me an email this past week. It's kind of an email-heavy week. I believe I got to all of you. Hey, if I ever do miss an email, don't take it personally. I reply to my emails personally. I don't use an assistant for this. So feel free to email me again. I love hearing from listeners. I love answering questions. And I'm just happy to know that you guys are there. You know, recording a podcast can be kind of lonely because you're speaking at a computer screen and I don't get your reactions. You might be laughing when you listen. You might be taking notes. You might be throwing things at the computer and telling me that there's no way that this all works. Of course, my response is going to say, it's just math. But I love hearing from you. Thank you for the emails. Thank you for listening to the show. Thank you for sharing the podcast with friends of yours who trade options. I've noticed a growth in our numbers from that as well. So you guys are awesome. I have the best listeners in the industry. I hope you have a fantastic weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.